Thank you. Okay, I guess we can make a start. Welcome to Symposium number 4 of EAA this year. This is Accounting and Business Research Journal's special issue on the role of accounting information in debt markets. I'm Edward Lee from the University of Manchester. I'm one of the co-editors of this journal, along with Mark Clatworthy of the University of Bristol and Juan Manuel Garcia Lara from University of Carlos III. So also with us today are distinguished panelist members, including Professor John O'Hanlon from University of Lancaster, Professor Fernando Penalva from University of Navarra, and also Professor Alfred Wagenhofer from University of Graz. So we know that debt market is a very important source of corporate finance around the world, but then in accounting discipline, it is relatively under-researched compared to the equity market. And with this in mind, we organized this special issue in conjunction with this symposium to help highlight and promote this area of research. Now, the whole format of this symposium is going to be very straightforward. We're going to have 3 presentations from, one from each panelist, 20 to 25 minutes. And then after that, we're going to open the floor to the audience for some, Q&A interactions. And then toward the end, I'm going to have just a few minutes to introduce to you the special issue and about the journal. So first up is John, so I'll hand over to John.
Good morning. This talk is, as it says on the title here, it's about the development of the IASB and FASB expected loss-based methods of accounting for credit loss impairment. So it's about how it's an accounting standard setting related issue that relates to how lenders account for the amounts that they lend. The talk's based significantly on research that's going on at Lancaster by myself and 2 colleagues, Noor Hashim and Weijia Li. Looking quite a lot at comment letters and other information that's come out about all of this process over the last 7 or 8 years. And it's funded in part by a contribution from the ICAW's charitable trusts. So the background for this talk, the financial crisis of the late 2000s, there was a lot of recognition that or a lot of claims that accounting for financial instruments was a problem. One of the things that was, just an example of this, a press release by the IASB that noted the importance of dealing in quickly with sort of issues that had arisen. There were the claims were raised that there were particularly problems with accounting for credit losses, the incurred loss model, which involved using what were termed triggers based on objective evidence as a way of justifying the recognition of credit losses, was perceived to be insufficiently forward-looking. Too little too late was a phrase that was used a lot with regard to this approach. So, and there were sort of quite a lot of political pressures raised in respect of this. So, for example, the Financial Stability Board made a sort of recommendation to G20 leaders that accounting standard setters should aim to go for an expected loss-based approach. And the IASB and FASB addressed that issue. They sought a more forward-looking approach. The process, however, has been somewhat controversial. It's taken quite a long time for the standard setters to come up with their standards. They haven't been implemented yet. The FASB one won't be implemented until 2020. There were a lot of conceptual issues arising, and also, perhaps most controversial in some ways, the FASB and the ASB were unable to agree a common approach to this issue. So in this talk, I'm going to talk about what happened and some implications and questions. Now, when the two standard setters started working on this, they initially came up with two separate approaches. The ISB came up with an approach that was essentially aimed at recognizing initially expected losses on initial recognition of an asset through time, effectively as part of the interest rate that was being, or the interest that was being recognized on the assets. So what they were proposing was that initially expected losses should be recognized through time. They didn't use the word matching, or they deliberately didn't use the word matching, but some people might argue that's what this looked like. And then if there was a change in expectations, this would be recognized when it occurred by discounting any changes by reference to this initially determined credit loss inclusive effective interest rate. The FASB, on the other hand, came up with a more simple approach in some ways, simply saying that that it was required that there should be a recognition at each balance sheet date of the amounts that contractual amounts that were not expected to be collected. Now, so they started from different points. It's useful at this point perhaps to illustrate some of the, or one of the main sort of issues that differentiated the two approaches. If you look at this example here, you've got in the middle column, let's say a bank issued or originates a portfolio of loans with a value of 1,000. So that's the amount lent. The contractual cash flows might be this, which gives you a contractual effective interest rate of 10%, but when they make the loan, the bank might know or expect that there's going to be some defaults, and that the effective interest rate using expected cash flows is only 8%. So you could represent that loan at origination as being the present value of the contractual cash flows discounted at the contractual interest rate, or the present value of the expected cash flows discounted at the expected credit loss inclusive effective interest rate. Or, as some would argue, apparently, you could take the numerator of the second expression and the denominator from the first one, put them together, and you get a number that's less than 1,000. And the question that arises, is this difference here a loss that should be recognized immediately, or is this shortfall something that should be measured over time? And essentially, this is what the ISB ideally would like to do, and they've ended up with something that approximates to this, and it looks as though this is what the FASB effectively want to do in their latest standard. Having sort of issued these two proposals, the standard setters got responses through comment letters. There were the overall impression was that the ISB model was seen as being a conceptually pure model in one sense, income statement focused, trying to get the income statement right. The FASB model was tended to be seen more as a balance sheet loss allowance adequacy approach, recognizing, of course, as we all know, that the income statement and balance sheet do tie up with each other. Nevertheless, this is one way in which it's been characterized. But they both had their problems. The ISB model was seen as being conceptually pure, but very difficult to implement. The integration of credit losses and interest was very difficult to, or so the preparers said, the banks, very difficult to implement. And also the argument was that mixing up interest and credit losses would confuse investors. The FASB model was criticised quite a lot for day one losses, the day one losses I just referred to. So they started off from different positions. They then tried to converge, or over a long period of time, they moved from their initial positions to a joint approach, and then this went on for a year or so, and then by about mid-2012, the FASB moved away from the attempt to converge, and the two standard setters ended up producing different standards, which I suppose in many respects mirrored what they'd originally proposed. What they ended up doing was in order to sort of compromise really between what the FASB seemed to want, which was a sort of loan loss allowance adequacy approach, and what the ISB wanted was a loan loss allowance. ISB wanted a sort of matching effectively, or connecting up of interest with credit losses. The FASB wanted a sort of loan loss allowance approach. They ended up coming up with this sort of hybrid approach whereby the book of loans would be broken down into a good book and a bad book. For the good book, the lender would recognise the higher of time proportional expected credit losses and foreseeable future losses over a specified period. The former of those was perceived as addressing the ISB aim to spread losses in some way, initially expected losses in some way over time, whereas the FASB, the second one, was aimed at addressing the FASB approach. There was a lot of, and for the bad book, all losses would be recognised immediately. There was a lot of suggestion that the compromise wasn't really very conceptually sound. Based on this joint, they called it a supplementary document. Based on this joint supplementary document, we've done some analysis of the comment letters, and it's quite clear that there was quite a big difference between what US commentators liked and what non-US commentators liked. So, for example, here you can see that the idea of differentiating between a good book and a bad book for impairment purposes was much more acceptable to non-US commentators than to US ones. The idea of using time proportionate approaches to recognising initially expected credit losses was much more attractive to non-US than to US. US didn't like it, non-US did. And the foreseeable future period approach, again, quite a lot of difference here between what the US preferred. The US were happy about this, but the non-US commentators weren't. One of the things that this raises in our mind is the possibility that in trying to move away from the incurred loss approach to a more complicated, perhaps expected loss approach, the standard setters were opening up issues that eventually made it difficult for them to converge. Moving on from here, we then move to this sorry, it's not working this now. Sorry, it's not working this. It's working there, but not there.
Aquí sí que pasa, pero cuando arriba no se ve.
It's doing it now.
¿Por qué? Vale, un momento. Tápame. Bueno.
Right, so after these, the comments on this supplementary document, the standard setters came up with this so-called three-bucket approach where they were effectively distinguishing between a category for which there was there had been no significant increase in credit risk since initial recognition of the loan, and categories where there had been a significant increase. And then the idea was that there would be partial recognition of losses for the so-called for the category for which there was no reduction in credit quality, and lifetime expected losses would be recognised for the other categories. This raised. And this went on for quite a long time, looking at this, a year or so, looking at this particular approach. And then in mid-2012, the FASB walked away from this approach, effectively saying that they didn't want to to proceed with a model, a method in which there was a difference between, or there were two separate measurement objectives. They didn't like the idea of there being two categories for the purposes of accounting for credit loss impairment, one of which would be a non-credit deteriorated category in which, for which a certain approach would be used, where expectations of losses hadn't changed since initial recognition, and another category, a credit deteriorated category. They didn't like that. They said it was confusing, there was a cliff effect, losses suddenly going up or down, recognised losses suddenly going up or down, opportunities for earnings management. There was a suggestion that the criterion for moving from one box to another was a bit like the incurred loss approach, and they moved to their currently proposed, or what's going to now be implemented from 2020 onwards, the current expected credit loss model, which requires full recognition of all contractual cash flows not expected to be collected, and has day one losses associated with it. The IASB pretty much stayed with something like the three-bucket approach, which involved partial recognition of losses for assets for which credit quality hadn't deteriorated. And there's all sorts of possible problems associated with the lack of convergence. It's difficult to predict the actual cost, the full costs. But one of the problems is that, well, one of the possible problems are referred to here. Certain large banks are going to have pointed out to the fact that they're going to have to do a lot of explaining to investors, to explain the differences between their numbers and perhaps other banks that are reporting under the other regime. There are costs associated with the fact that the FASB model, the recognition of day one losses under the FASB model, it involves a double counting of initial loss expectations. There are all sorts of earnings management opportunities or problems. It could, and this is perhaps relevant particularly in this context, it could disincentivize lending to higher credit risk borrowers. It could create incentives for lenders to run down loan books to realize gains because of the assets being undervalued because of day one losses. And these concerns, this is a concern that was actually expressed by two FASB board members who dissented from the FASB standard because of all of this. They pointed out the possibility that people might interpret this approach as signalling that the incremental loss would be recognised not based on the economics of the transaction, but rather because of some prudential desire to have a higher level of loan loss reserves. And they also argued that it was potentially, it conflicted with the concept of neutrality. There's all sorts of other arguments they raise, which I find it difficult to quarrel with about what this requirement. Having said that, some people do argue that day one losses, although they're not conceptually attractive, do get you to the right place by a not very conceptually attractive route, so early recognition of losses and so on. Now, the question that I particularly want to get to here is the question of whether the incurred expected loss distinction itself has been helpful. In trying to get away from the incurred loss model, the standard setters have tried to address or have embarked upon the creation of these expected loss models, and this has led them along difficult paths. So the ISB have had a fairly protracted process of getting from their conceptually appealing but operationally difficult model to something that was pragmatically operational. The FASB have come up with a model that avoids the incurred loss trigger, but at the cost of a conceptual difficulty, this full recognition of day one losses, and the standard setters have been unable to converge. There is this quote I'm just going to put up here is from one of the comment letters on the ISB supplementary document. This is an American investment bank making what I think is a very important point here, which is relevant to all sorts of things. They make the point that the financial crisis was not caused by inability to reserve in a timely manner for credit losses. The crux of the problem wasn't whether we had an incurred loss model or an expected loss model. The crux of the problem was there were just too many bad loans. And they make the very important point, which is probably familiar to anybody who has to regulate anything, that hard cases make bad law. You know, the feeling that maybe the standard setters have tried to change it maybe a bit too much in response to a very severe problem which accounting couldn't have sorted out anyway, and have then gone down these long, difficult paths which have left them in the difficulties that still exist with regard to conceptual problems with at least one of the standards, I think, and the inability to converge. There's also, in my experience from looking at lots of comment letters and other literature, a lack of a shared understanding of what expected loss versus incurred loss, that distinction actually means. Some people seem to think it means that that impairment's based on expected losses. Some people think that it means that impairment's based on expected losses where you use forecast of future events. Some people think that expected loss means that you spread the initial losses out over time. So there's a lack of shared understanding of what the terminology means, as far as I can see. And this has led us to this sort of conclusion as to how do you try to sort of make sense of all of this. One of the conclusions that we've come to is that all impairment methods, whatever they are, require the use of a current information set, whether that current information set is the narrow criteria that are currently defined in IAS 39 or the IFRS and US GAAP, or some wider information set. So some information set has to be used. And that leads you to expectations about future cash flows, shortfalls relative to contractual cash flows, risk, etc. That leads you to an estimate of an appropriate carrying value for assets, which when compared with the pre-existing carrying value of the assets, could be characterized as giving you an answer to the question, what loss, if any, has been incurred, and what impairment, if any, should be recognized. So in this representation, all impairment methods could be expected loss and incurred loss, because expectations are here, and you use the expectations to determine whether a loss has been incurred. And in this representation perhaps highlights the fact that the key distinguishing feature between impairment methods is not whether they're incurred loss or expected loss, but the information set that can be used. Should it be a restrictive information set, as is currently in GAAP, or a broader information set? And another issue that arises, which has bedeviled this whole process, in my view, is the need to clarify whether impairment should be based on the assumption that initial carrying values already reflect initially expected shortfalls relative to contractual cash flows, going back to the numerical example before, or should they be done on the basis that shortfalls relative to contractual cash flows should be recognized immediately as soon as the asset's recognized. This whole process leads to a sort of a concluding question: could acceptable outcomes in accounting for credit losses have been achieved more easily and more quickly? And could convergence, which hasn't been achieved, could convergence between ISB and FASB have been facilitated by focusing less radically on the information set that's used, that is permitted to be used for measuring credit impairment, not whether the impairment method is incurred loss or credit loss, expected loss rather, and meanwhile clarifying whether impairment should be calculated based on initial carrying values reflecting initial shortfalls, or on the basis that initially expected shortfalls relative to contractual cash flows should be recognised immediately. So this is something that this could have been a simple focus which could have avoided all sorts of complications. This needed to be sorted out, and I don't think it has yet. Bearing in mind, of course, as accounting standard setters customarily do, subject to all the problems and pressures they have to deal with, hard cases make bad law, and that, of course, quoting from the FASB dissenting opinion, it's not their job to make a prudential desire to have to meet a prudential desire to have higher loan loss allowances. So these thoughts could have some implications for the future. Once the accounting standards are implemented, I guess there'll be lots of empirical research about how they work and so on, all sorts of implications of those. And then at some time in the future, I guess the accounting standard setters will revisit the issue of credit loss impairment, hopefully not as the result of some major financial crisis, but I'm sure it'll happen. They'll have to be revisited at some point, and perhaps the lessons from this process can be brought to bear at that time. Okay, thank you very much.
Okay, thank you, John. Next we have Fernando. He's going to talk about debt contract and conservatism.
Before I start off, I would like to thank you, the editors of ABR, for inviting me to join this panel. It is an honor for me to be here. I'm going to talk about the role of conservatism in debt contracting. So perhaps you do not think of conservatism too highly, so if you want to leave the room during my presentation, I will not take it personally. Okay. Conservatism has been present in accounting for many centuries, and there are four explanations for conservatism: contracting, litigation, taxation, and accounting regulation. Evidence seems to indicate that debt contracting is the most important. When I talk about conservatism, I refer exclusively to conditional conservatism that, as you know, involves the timely recognition of unrealized losses than of unrealized gains. Recognition is conditional on the arrival of new negative information. And for this reason, conservatism is potentially very useful in debt contracting. The pointer is not very intuitive. What are the reasons that for the debt contracting value of conservatism? The literature has put forth four explanations. First, lenders use lower bounds of the value of the assets of the borrower in the loan granting decision, and conservatism can supply these lower bounds. We have evidence by Alfred, for instance, in an analytical model that shows that conservatism maximizes the ex-ante probability of obtaining financing. Lenders want to be informed about losses as soon as possible. Conservatism facilitates debt monitoring because it accelerates the violation of debt covenants and the transfer of control rights. In this way, when lenders step in, they can stop managers from making decisions that can erode the quality of existing loans. Ex-ante conservatism reduces managers' tendency to invest in high-risk projects, right? Projects that are likely to end up having a negative present value. And exposed conservatism is also a good monitoring device because it induces managers to abandon poor-performing projects earlier. And finally, conservatism limits available opportunities for manipulation of accounting numbers that are used in debt contracts. So what evidence do we have about what I call the debt, for short, the debt contracting hypothesis? I selected 4 pieces. Okay, this reflects my personal preferences, so I apologize beforehand if I did not select your paper or your favorite paper. The first piece of evidence is by Ball, Robin, and Satka in 2008. They use it's an interesting piece, in my view, an interesting piece because they use an international sample of 22 countries. And they use the size of debt and equity markets as a proxy for the demand for certain properties of accounting numbers, conservatism among them. What they find is that the size of debt markets, but not of equity markets, is associated with reporting conservatism. And they conclude that that conservatism probably exists more for its role in debt contracting than to inform equity markets, which seems to be the opposite conclusion that regulators, standard setters have in mind. Okay, information is useful, okay, for economic decision making. The second piece of evidence is by Betty, Weber, and Liu. The primary criticism of the debt hypothesis is that conservatism is not necessary. Firms could report, quote unquote, in an unbiased way, on a symmetric way, and lenders in the debt contracts, they will adjust downwards the reported numbers, okay, to include the appropriate dose of conservatism. What they find, they examine a bunch of real contracts, and they find that lenders do use contractual modifications. In particular, they use income escalators. So it's predetermined reductions, for instance, in earnings, in positive earnings, used in the computation of the covenants. But in addition to the income escalators, lenders also demand reporting conservatism. So this means that lenders do not meet their demands for conservatism exclusively through covenant modifications. They also demand reporting conservatism. The third piece of evidence is by Ball, Bushman, and Basbury. Here, they use a setting of syndicated loans. As you know, in a syndicated loan, a group of banks get together to spread the risk of a particular loan. And in the syndicate, there is a lead arranger, a leader, and it's the bank that deals directly with the borrowers, with the borrower, performs the due diligence, and Exposed is the one that monitors the performance of the loan. And this creates certain information asymmetry between or among the members of the syndicate. And for this reason, the lead arranger is required to retain a higher proportion of the loan. Okay, and what they find is that the proportion of the loan retained by the leader is a negative function of the level of reporting conservatism of the borrower. So we can see that conservatism in this setting reduces the information asymmetry between the borrower and the lenders, but also reduces the information asymmetry among lenders. And the final piece of evidence I want to talk about is Perkins, Riemannian, and Zhang. The hypothesis predicted information asymmetry between lenders and borrowers will cause lenders to demand for more conservatism. Okay, so if this asymmetry can be reduced somehow, the expectation is that lenders will demand less conservatism. Okay, and what they find is that when the lender has representation on the board of directors of the borrower, he can exercise more monitor, and then they find that in this case, the lender demands less conservatism. And what's interesting, at least in my view, is that it's not what drives this result is not the presence of a director of the lender on on the board of directors of the borrower, but the additional monitoring. So you don't have to have a director on the board of the borrower. If you monitor more regularly or follow closely the borrower, then you will obtain the same result. So what are the other contracting benefits of conservatism documented by empirical research? Conservatism is associated with lower interest rates for borrowers, better their ratings for conservative firms. Conservatism accelerates covenant violations and facilitates the timely signaling of default risk. Conservatism improves investment efficiency because it facilitates access to debt financing. Conservatism also improves creditors' recovery rate in case of borrower's default. Conservative firms tend to do less risky acquisitions. Conservatism is a governance tool, is a good governance mechanism. And conservatism reduces information asymmetry, as we have seen before. And one of the issues commonly raised by referees is, can firms credibly commit to reporting conservatively? And then the literature provides two answers. First is reputation, and second is litigation. Debt market relationships tend to be multi-period. And deviating from conservative reporting is likely to negatively affect firms and management reputation. And the second explanation is, if the firm deviates from reporting conservatively, the litigation risk for the auditor increases, and therefore the auditor tries to prevent this behavior. So far, all the evidence I discussed is based on association studies. So what they find, the results they find, are consistent with the debt hypothesis. But you cannot infer causality from their results. And the reason is the following. Conservatism proxies are inherently linked to the economic characteristics and performance of the firm. This is so because conservatism proxies are based on accounting numbers, and the objective of accounting is to measure economic performance. This implies that separating conservatism from the underlying economics of the firm is very hard. Because what we always say in our research, we try to control for the economic characteristics of the firm. But this is hard to do. So one possible solution to overcome this separation problem is to identify settings in which an exogenous external shock causes a change in the demand for conservatism without affecting the firm's underlying economics. I'm going to show you a few examples, a few pieces of research in which they are able to identify these settings. The first piece is by Gormley, Kim, and Martin. And the external shock in this case is the entry of foreign banks into India during the 90s. The expectation is that the entry of foreign banks will increase the demand for conservatism, and borrowers will supply more conservatism. Why is this so? First, foreign banks tend to be big, large, Citibank, JP Morgan, HSBC, etc. And initially, these banks have an information asymmetry with respect to local banks. They don't have as good a knowledge of the borrowers as the local banks. So they tend to rely more on information in the financial reports. And so they are likely to demand for more conservatism. Second, these big foreign banks tend to attract the best borrowers, the biggest and the most profitable borrowers. This means that the pool of remaining borrowers is riskier, and this causes local banks to increase their demand for conservatism. And finally, it's expected that local banks will end up adopting the best practices of foreign banks. Well, for all these three reasons, it's expected that the entrance of foreign banks into India will cause an increase in conservatism. And this is exactly what they found. Again, this is a nice setting because the entrance of foreign banks into India, in principle, does not change the economic characteristics of local borrowers. So they're able to separate the measurement of conservatism from the economic characteristics. The second piece is by Jayaraman and Shiva Kumar, here the shock is the passage of anti-takeover laws in certain states in the United States. Okay? Prior research has documented that ATLs entrench manager, and this is a bad thing. And also research has documented that it has negative effects on lenders. So it's expected that in the affected states, lenders are going to demand for more conservatism. And again, this is what they find. Okay, and they find that the borrowers supply more conservatism, and especially firms with higher debt contracting pressures. The fourth piece of evidence is by Ayer, Chen, and Pevsner. And here the external shock is a 1991 Delaware court ruling that expanded the scope of directors' fiduciary duties to include creditors when a Delaware firm is in the vicinity of insolvency. What this complicated sentence means is the following. The directors, the members of the board of directors, are supposed to look after the interests of shareholders. But in the case in Delaware, after 1991, if the firm is in the vicinity of insolvency, directors are also responsible for the interests of lenders. Okay? This, again, the ruling did not affect the economic characteristics of firms, the economics of firms, however, affected the demand and supply of conservatism. And this is what they found, okay? That after the ruling, conservatism significantly increased for near insolvent firms. The final, here the link is that the directors of affected borrowers pressure managers to report more conservatively. And the fourth piece of evidence is by Martin and Rochaury. The external shock is the initiation of CDS trading, the credit default swaps. As you know, credit default swap is like you can purchase insurance, okay, for credit risk. And what they find is that lenders that insure the borrower's default risk with CDS demand less conservatism, okay, and they also reduce monitoring. Okay, again, the initiation of CDS trading does not affect the economics of borrowers, but affects the demand for conservatism. In this case, affects negatively the demand for conservatism. Okay, and so far so good. Okay, all the evidence I presented, okay, supports the role of conservatism in debt contracting. But are there any threats looming in the future against the role of conservatism? And the answer is yes. Okay, at least supporters of conservatism think that fair value is not a good idea, okay, because it reduces the contracted value of conservatism. And so the claim is that fair value accounting for balance sheet items without liquid markets may induce managers to recognize unverifiable gains in earnings that could reduce the contracting value of earnings and of conservatism. Okay, so this is the claim. And this piece of evidence seems to support this claim. Okay, the merger in 2011 uses a sample of U.S. banks with private contracts, and he documents a sharp decline in the use of debt covenants based on the balance sheet. Okay, noticing in 1996, 80% of debt contracts contained covenants based on the balance sheet, whereas in 2007, only 32% of the contracts contained those covenants. However, the use of covenants based on the income statement has remained relatively flat, okay, throughout this period. He attributes this result to the increased emphasis of FASB on fair value, okay, which has reduced the contracting usefulness of the balance sheet. The second piece of evidence is by Boldy and Shiva Kumar. Okay, and it's an international sample because they look at the adoption of IFRS. It's more pertinent to us. Okay, they find that the adoption of IFRS has led to a significant reduction in the use of accounting-based covenants in debt contracts. And again, they attribute this result to the rise in the use of fair value introduced by IFRS, which has reduced the contracting value of accounting information, okay, because of the additional opportunities for managerial discretion. Okay, fair values are not easy to measure, and this allows for additional discretion. However, more recent evidence, very recent evidence, seems to reach opposite conclusions. Okay, the Merchant, Donovan, and Larson, 2016, they look at the adoption of FAS 159. As you might know, Standard 159 allows firms to record virtually any financial asset and liabilities at fair value. Okay, you can use equity method investees, you can use fair value for them, anything. What they find is that the majority of contracts continue to include financial covenants affected by the standard without any modification. So it seems that the increased use of fair value did not affect the contracts. Okay, this is in contrast to the emergence evidence in 2011. Okay, the evidence I showed before, and they conclude that in many cases fair value is useful for contracting. Okay, and in the few cases in which fair value can be detrimental, lenders modify the contracts to exclude its effect. Okay, and more even recent piece of evidence by Badia et al. They use the adoption of Standard 157. As you know, Standard 157 deals with the disclosures that firms have to make about how they compute fair values of financial instruments. And fair values are classified in three levels: level 1, level 2, and level 3. Okay, level 1 are fair values based on prices of identical instrument that trade in very liquid markets. And level 2 and level 3 are based on inputs that are not identical to the item you're trying to fair value, or are based on management estimates and in models. So for level 1 fair values, we talk about mark to market. And for level 2 and level 3 fair values, people refer to those valuations as mark to model. Okay, because you get whatever you want using your model and tweaking with the assumptions. Okay. Well, what Badia et al. Find is that firms holding higher proportions of financial instruments measured at level 2 and level 3 fair values report more conservative earnings, okay, related to these instruments. But is that the intuition behind this result is that investors know that level 2, level 3 fair values are less reliable because of the additional assumptions required. And they price protect by discounting the share price. They're willing to pay less for the stock of that firm. And firms react, okay, and try to mitigate investors' discounting by reporting conditionally conservative these measurements. Okay, so the bottom line of this paper is that conservatism and fair value can coexist. Okay, you can have them both. They are not sort of antagonistic properties of accounting numbers. Then does conservatism, remember that at the very beginning, in my second slide, I told you that conservatism is a good debt monitoring device because it triggers, okay, the violation of covenants and accelerates the transfer of control rights. Okay, is this always the case? Okay, evidence by Dirang et al. In 2017 in JAR. Okay, they find that the earnings definition used in performance covenants is not conditionally conservative. Okay. The definition used in those performance covenants is not net income. For instance, net income, the coverage ratio is defined as net income divided by interest expense. Okay, but what they put in the numerator is not net income. It's a modified measure of earnings, okay, and this measure of earnings is similar to EBITDA. It's not exactly EBITDA, but it's very similar to EBITDA. It's very close to CompuStat item operating income before depreciation. Okay, and this is surprising, isn't it? Because we thought that the purpose of those covenants is to accelerate the violation of the covenant. Maybe this is the case, okay? But at least this partially contradicts claims that conservatism triggers the covenants earlier and facilitates the transfer of control rights, okay? In this particular case, in the case of the performance covenants, this doesn't seem to be the case, okay? And So lenders are interested in other properties of accounting numbers other than conservatism in the case of performance covenants. Okay? What they find, these authors, is that the contractual adjustments made to earnings in performance covenants are income increasing, are economically large, and change the information content of earnings. And these adjusted measures in performance covenants are significantly better at predicting future cash flows than GAAP earnings. So it seems that the goal is to predict future cash flows in this particular case. Okay, and this is consistent with evidence in Lee 2010-2016 showing that net income is stripped of transitory items to make it more useful for debt contracting. Okay, so what this means is that other properties of earnings, in addition to conservatism, enhance debt contracting efficiency. Okay, this is my last slide. Okay, this does not mean that conservatism is not important anymore. Okay, and actually in the paper, the Rang et al. Point out that conservatism is probably useful in covenants other than performance covenants. Okay, and in particular, probably conservatism is useful in capital covenants, okay, such as net worth, leverage, as documented by previous research. Capital covenants are those covenants mostly based on balance sheet numbers. Okay, Christensen and Nikolaev show that performance covenants act as tripwires to transfer control rights. Okay, however, the evidence in the Rang et al. Indicates that conservatism does not play a role here. Okay, they set the thresholds, okay, so that the borrower trips the covenant at a certain point, but conservatism doesn't seem to play a role here. So what is my conclusion? Okay, so that more research is needed to determine what covenants in the contracts rely on conservatism and to what extent. And in summary, okay, the empirical evidence overwhelmingly supports the debt hypothesis, but we need to refine some of the theoretical arguments that support it. And thank you very much. I look forward to your questions.
Thank you, Fernando. Next we have Alfred.
Right, I'd like to thank the organizers and the editors of ABR very much for inviting me. And actually what I'm going to present is very much related to what Fernando discussed, and it's good to hear from empiricists that empirical evidence is very diverse, which is exactly what I can show you with a theory perspective of what I discuss here. So the main topics I briefly try to address is how does accounting information facilitate or hinder raising capital, or the other one is like how does it enter into debt contracts, how do people use it in covenants. The focus of my talk, I'm going to give you very few examples of research that tries to make these points in terms of focus on precision, which means relevance and reliability, so there's not much, so it's usually pulled together. And the other one is bias of information, which means do we want to have conservative accounting or don't we want to have that? The theory perspective I'm addressing is information economics, contract theory, agency theory. This is the contracting kind of basis from the economics. And I briefly conclude with suggestions what people could do in the future. So to start off this theory perspective, it's kind of useful to briefly get back to the objectives of financial reporting. And as John was telling in the first presentation here, so IFRS and also FASB obviously do a lot of thinking in terms of what information do we need to be useful, and what their usefulness concept essentially is that's laid out in the conceptual framework is provide information for capital providers. And the interesting part of this is not only equity holders but also debt holders. So it should be information that's useful for debt holders, buy, sell, hold debt instruments, and also information on how to settle loans and so on. And then once you look at the conceptual framework, and there are a lot of difficulty with figuring out how to deal with stewardship, for example. So the ISB's view essentially is the use of accounting information in contracts is out of the scope of IFRS. So they don't want to do this, essentially, and the main reason they give is parties are free to agree on terms of contracts. So once you negotiate the contract, you can plug in anything you want. You can make adjustments to any accounting numbers if you ever look for including an accounting-based covenant. So the problem arises with that argument, essentially, once you consider there is a lot of debt contracts that will be standardized. So, and also equity is a contract, essentially, right? So there's very standardized contracts, and so it's very hard in many places to plug in sort of debt covenants, particularly negotiated. And the other one thing, if you want to deal with those things, you increase transaction costs, and so writing enforcing contracts would be costly, so it wouldn't be that sort of, the argument doesn't bear as much as one might think, right? So that contracts, in a sense, then is question is, and this is my sort of way to look at it, is this demand information different from equity holders? So do we have sort of distinction between debt and equity holders that use this information? And a lot of what Fernando already talked about would suggest there is a difference. For example, would it sort of come out in adjustments to IFRS information, for example, when writing contracts? So I'd like to discuss two ways of that the theory pieces deal with these topics, and the one is like so the idea of using ex-ante in usefulness of accounting information. That's much more in line with the ISB approach, because it's addressed to debt holders who think of providing a credit, even though in the back of their minds is usually already sort of the contract, right? So it's hard to really clearly distinguish between those two, but ex-ante would be information that would facilitate financing through debt contracts. And the intuition that's usually given for from many of the papers that are given that look at these issues is more information is always better. More precise information is always better, which translates into debt financing would be more efficient. And the other one is like conservative information is preferable, or if you're on the opposing side from conservatism, you say, oh, neutral information should be better, right? So this is like the way people tend to think about these basic issues. So the question is, which accounting information do we look at if we look at it from an ex-ante perspective? So actually, we want to know something about the future, right? So we need to have some, for example, assets and asset valuations that would give us a signal about future profitability or ability of management to invest in new projects. So this kind of information. So it's only this forward-looking kind of information that we're interested in. But that's not all of it. One example would be to do collaterals, for example. And I give an example, and Fernando already talked about it a little bit. So, but I think it's obvious why I choose this. But the idea being here is like, this is one of the very few ex-ante papers, as far as I can see it. So to give you some flavor of the theory arguments that are being used in this area, consider the following setting. The firm is a positive NPV project and goes to a bank, for example, lender, to finance it. And the problem that you always have to deal with, in a sense, is like there's something that the firm has to do, so it should be incentive compatible. Because once you have this lender relationship, then you end up with this kind of equity being a call option, and then people get very different incentives to engage in activities. So essentially, here it is like incentives to work hard. So because that shifts the profitability of the project to the positive side, right? So the lender's decision rule is. I need some collateral, otherwise in certain cases you don't want to extend credit because it's too risky, for example. this project, right? So the lender wants to provide information, so needs information about the asset values that are there. So this is the direct link between sort of the balance sheet and sort of future financing activities. So the question is, how do we measure the assets on the balance sheet, right? So one example would be, say, oh, okay, full information which translates to fair value accounting, for example. So in this part here, you see there's a signal which is the asset value, a carrying amount, and this would be the expectation of what's the value of the asset. This was 45 line in this regard. So if the asset is the asset value. So essentially, suppose you need to have collateral of a minimum size, which is this threshold Y, for example, then apparently if you do fair value accounting, so you report along this line, basically, then your assets are not sufficient in this area to receive the credit. The benefit comes from here, so this is this red part where you have sufficient assets or sufficient values of assets that the bank says, oh, okay, I grant you this loan, right? So this is the standard kind of direct solution. So one can think of other accounting rules that say, oh, okay, let's present or inform people less than fair value, which is this straight line here. And then essentially what's happening is that the lender must infer from the conjecture from what you see as the accounting signal what's the asset value actually is. So if you say, oh, okay, there's a non-disclosure area where you don't get specific information about the asset value, then you generate conjectures, which is conditional expectations of the value of the asset, right? And so you could do this here in this regard. So, okay, we disclose here and don't disclose the bad stuff because it's not useful. So, but then obviously you don't get any credit anyway, so it doesn't matter. So for that solution, it doesn't really matter. And what this paper actually shows, if you flip sides essentially and you only report really bad information, then you get an improvement. And to see how that works, suppose this is sort of impairment area. So if value is really bad, then you report it, and everybody says, why would you do this, right? Because you don't get any credit, but you wouldn't get that same thing with fair value accounting anyway, right? And then if you don't report the rest of the values, essentially the bank would come up with an expected conditional value, which is this one, and it would be this one, right? So you can't distinguish between those signals because you don't see this. And the funny thing is, one can show if you do this impairment stuff, then essentially you push it to a level where the asset value is just achieving this threshold. So you just show or disclose that much of bad information that if you don't disclose, the information must be sufficiently good in order to tell the lender, to have the lender believe that it's sufficient value there to extend the credit. So essentially what's happening, you don't report this one, lenders expect that one, and you expand the size of the possibilities that you can get credit, and this is actually welfare maximization. And this is called Bayesian persuasion. So you discuss, you disclose things in a particular way to shape and manage expectations. All right. So, and this is exactly what impairment does, for example, and it would even give you sort of a particular trigger where impairment would be optimal in this case. So, showing that more information is not always better, particularly if you try to come up with particular ways of decisions. All right, moving over to exposed usefulness of accounting information, there's a lot of literature that uses different frictions that you want to deal with in this contract, and the typical frictions would be productive effort, as was in the first example I gave you, but also information acquisition decisions. So do you want to get more information given you have this kind of contract? The other one would be asset substitution, jump in and do a more risky project rather than that you propose to the lender. Or many people assume there's a private benefit from investing, like empire building. You want to do this investment regardless of whatever, you know. So these would be typical frictions where sort of a contract and using accounting information would be beneficial. So the accounting then provides information that's being used in the contract, and these are the covenants, and there are many ways, or many different covenants, some of those which I list down here below. So for example, and this is what most theory literature looks at, the transfer of decision rights. So if the information goes below a certain threshold, then the lender can make a decision whether to abandon or liquidate the project or not. All right, but it would also be earlier repayment, dividend payouts, restrictions, financing restrictions, performance pricing, frozen rolling gap. There's a lot of literature looking at the incentive effects of all these kind of different frictions and how these covenants might improve things. So, and again, the hypotheses here are the same as before, so that's the gut feel kind of thing. More information is always better, and the other one is conservative, or if you believe in fair value, neutral information will be preferable. So this, and you find reasons for both of those usually. So the one example I'll give you is a paper by Giegler et al. And it's very intuitive way of doing this abandonment option contracts stuff, where there is a covenant and that's given. So essentially the setting is, again, we have a firm with a positive NPV project, and it raises debt capital to finance that. And the return is obviously risky because otherwise it's not very interesting. And one can liquidate the project in between. So one can really stop it and then sell the rest of the project at the liquidation value. And obviously the liquidation value should be less than the NPV ex ante, because otherwise you never invest, right? So liquidation is not a good option, but it would be a better option than if it's really going bad, okay? So one can think in these terms, what would be sort of the optimal allocation of decision rights? And the efficient decision would be liquidation if the expected return, given the accounting information, is less than liquidation value, right? And if it's more than that, you should continue the project. And I give this here in this is like the accounting information that changes the expectation over this range, and efficient liquidation would happen where the expectation is exactly the L. Right? And you would ideally liquidate the asset and otherwise continue with the asset. All right, so, but this is not what sort of the incentives of the people involved show, because in such a case, the firm would always want to continue the project. Why is that the case? Because equity is a call option, and so if it's really going bad, I mean, you always have a positive effect on your side. It's always better than zero, right? Which you would get if you liquidate the firm, because all the revenue goes to the lender. So the firm would always want to continue the project, right? So what about the lender? Well, one would expect the lender takes a efficient decision, but actually the lender does not. And the reason being is that the lender considers the own revenue and payoffs, and this would be the debt repayments, right? So expected debt repayments, and these must be less than what the project is like, right? Because otherwise the firm wouldn't do it, right? So the decision rule of the lender is a different one than that one that would be the efficient signal, because there would be expected return, and here we have the expected debt repayment, and this is less, which means that the lender really liquidates more often, all right? So we got the lender liquidating here more often, so this is inefficient in some part. It's efficient in the other part, right? So you got this tension between those two groups. So how does that play out? We have this covenant, and that's given in this paper to control, it gives the control to the lender if the interim signal is below a particular threshold. Right, and one can use sort of a binary setting that's could be continuous, but binary it works like that. And so essentially, there are two errors one can do. The one is type 1 error. You liquidate the project even though actually it's profitable, right? Or type 2 error, the project is continued even though the conditional expected return is less than L. So you actually should liquidate the project. And once one looks at the conservatism biasing information, then conservative accounting has two distinct effects. what most people see and observe is it increases the probability of unfavorable signals. So more biased, more conservative accounting puts you in a situation where unfavorable information is reported more often. And you're much more careful with the favorable information, right? But it's only one part of this effect. So the other one is the more you report about low, the less precise this information gets, because you collect and have several kinds of information down there, but the more precise the good information becomes, right? So we have these two effects: the probability of bad information, and the sort of the precision of that information, and one can play around with those. And what's so nice in this paper, for example, is that you can always show that the marginal type 1 error is greater than the marginal type 2 error, because ex-ante the project is favorable, right? So you would invest. And given that, you need, intuitively, you need a very precise signal to overturn your priors and really liquidate the project, which means you are aggressive. Ideally, so this paper comes to a result which says, oh, aggressive reporting, which is the negative of conservative, right, would be optimal in this setting. And so people were kind of, oh, this is like very weird, and why would you do it? But the intuition is clear, I think. And so there's been a lot of other papers following the Giegler et al. Paper to figure out, oh, are there other conditions that show that even in such a setting you would come up with conservative information, and there are several papers that do as a substitution in there, and also contract renegotiation, for example. And I give you one more example which is a paper by Volker Laux from a very recent one, which sort of mingles several of these aspects I was talking about together in one general setting. And the idea here is, again, the firm raises a project and has a project and raises that capital to finance it. And again, there's management effort in there, because otherwise it's much easier to contract if there are no major decisions being taken afterwards, right? And again, there's a covenant that would transfer control to the lender if the interim signal is below threshold, which is the same as we've seen before. And the new issue here is management has information, but can do earnings management or manipulation. Right, so can manipulate the report, and obviously managers would always want to keep control, so they push the signal upwards so that it doesn't go below the threshold, right? So just to keep control. And then this paper sort of compares two settings: the no renegotiation setting and renegotiation setting. In the no renegotiation setting, we look at, is it useful to write a covenant, or should we just ignore accounting numbers, right? And so there are many things happening in this paper, but the idea being, if you start with the setting with no covenant, then there's no misreporting, because the accounting information is not useful for the contract, right? So you get rid of earnings management. But on the other hand, there's also no early liquidation, because then always the manager always reports, oh, high, or doesn't report, and ex ante you don't liquidate, right? So you get this kind of thing. Once you come up with a covenant, then you start misreporting. The incentives to misreport are there because you write this covenant, all right? But on the other hand, you are not sort of sufficiently usually good in order to push everything to the top, right? So there will be some bad outcomes to some extent where you can't really avoid those. And then you generate liquidation. And that liquidation is actually efficient, because obviously the signal was really bad, right? On the other hand, if you report high signals, then essentially it's unclear whether the setting is good or you were successful in manipulating. So you lose information content on the upper end, essentially. But one can show that writing covenants is still useful as long as the information content gives you some sort of negative signal. So if you only report a good one, I mean, then it's like no covenant, right? But otherwise, you always get more information, and you can show it's useful to do this, but it depends on the quality of the accounting system, right? So more quality accounting system would reduce the manipulation incentives or increases the cost of that. So this is the no renegotiation setting. Once one considers renegotiation, and the assumption here is to be clean in such a model that is costless in renegotiation, and trying to figure out how do things change once you allow for renegotiation. Okay, so starting with the no covenant part, then again we end up very closely related to what we've seen before. If there's no covenant, but you can renegotiate costs without any cost, then there's no manipulation. And exposed efficient liquidation, because you can always sit together and renegotiate and say, oh, okay, I mean, actually it's bad, but I would not want to liquidate. So if the lender likes to liquidate the project, then you say, oh, okay, pay me something, right? And they negotiate on those things. So which means that the firm can extract some of the benefit, because the lender has to provide some incentive to renegotiate, right? But this lowers effort incentives, so your project value goes down, because this decreases sort of the benefit to the firm, right? So because the lender must give in to some extent in the renegotiation. I mean, so it's exposed efficient, but ex ante it changes the incentives, and so the project value gets lower. If you go to the covenant part of this, then again we have manipulation, and then comes an argument which is driving much of the result, which says, oh, okay, I have manipulation incentives, and now we sit together and talk about in the renegotiation phase about this project, and should it be liquidated or not. But once you said, oh, I pushed it up, but actually it's low, then actually you would want to sort of have the benefit of liquidation, because liquidation value is higher than what you know. But you never give in, right? You never say, oh, I manipulated the information, right? So once you never do this, then we end up exactly as we had been before, right? So it's like this setting without any renegotiation, and we get the same kind of issues. So essentially, what the end effect of this paper is, the covenant is preferable if the accounting system is strict, which means more precise information is a good thing, and this actually creates the incentive to write covenants. Right, so it is a direct link between accounting information and covenants. And the interesting thing I'd like to point out about this paper is there are many things that happen at the same time, right? So productive effort, misreporting incentives that are endogenous, frequency efficiency of liquidation, and also the change in the face value of the debt, which changes the incentives again, right? So there are many things being entangled in here. So what do we know? One thing that we can show, and this is not that dissimilar from what Fernando talked about with the empirical literature, the conventional assertion and predictions, better information is preferable, conservative accounting is good, do not necessarily hold. One can see in particular settings it's either the reverse, or it goes like that, but under certain conditions only. So it's really that contracts are really fine-tuned to economic settings, as long as there's sufficient leeway in contracting. And they also change the economic efficiency of dealing with projects and the value of firms, essentially. The insights are very complicated to some extent, and this is the reason why many people use mathematics to do this, because that's the only way to get through the whole thing, because otherwise there are too many things happening at the same time. And for many it's uncomfortable. I mean, for empiricists it's like, oh, theory gives us this or the other one as information, so what do we need? Should we be able to pick, or shouldn't we be able, but actually from a theory perspective, I think this is really good for empiricists as well, because one can really pin down settings, get more specific hypotheses that can be tested, right? So I think this is really a benefit of this literature. So I briefly end with suggestions for theoretical research in the area. Contract type frictions. How does that relate to each other? Because it depends really on the friction that you impose and which are more prevalent in a particular setting. Choice and combination of covenants. We don't know that much about these things. Which kind of covenant would you choose? Would it be based on accounting numbers, cash flows, things like that? How do we deal with adjustments of those things? Endogeneity of investment and financing. Even financing a priori is endogenous, right? Multi-period contracting. So what happens with, if you look at different periods, income-based or balance sheet-based contracts, for example, then obviously all this area about renegotiation, is it feasible? Can one do it, or is it impossible? Risk aversion, that's what few people deal with, and many more research opportunities. I think it would be a fancy topic for the future. Thank you.
Thank you, Alfred. So we still have a bit of time, so we can open up the floor to the audience. So anyone? It's a bit hard for me. It's a bit glaring here. Anyone? Okay. Yes, please. Can you just introduce your name and your institution, please?
My name is Tuan Ho from the University of Bristol. I have a question about, do you have, Professor John O'Halloran, you say something about an investment bank have comments on the FASB and IASB approach. Do you have any information about the comments from other users, for example, debt analysts, credit ratings agency, on this matter, because they're also a very important user of the account information?
Yeah, one thing we've noticed is you don't get very many comments from users. We have got some from analysts or analysts professional organisations like the CFA, but you don't get very many comments from brokers and so on. I suspect it's partly because they don't want to necessarily, or somebody's told me this, that they don't really want to reveal how they use the information. As analysts, so there's some of the analysts' views that I've seen, which is unusual relative to most of the commentators, do have a preference for fair valuing everything, actually. That you do see that sometimes. That's a minority view if you look at the overall comments. I suppose analysts and users would obviously prefer timely relative to non-timely recognition of losses, but they, like anyone else, will also be aware of the danger of over-recognising losses too much too soon, earnings management opportunities that arise from over-recognising inflating loss allowances and so on. But I think it's true to say that there aren't, if you look at the comment letters that you see in response to the exposure drafts, that you don't get a lot of comment from users.
Okay. Yes, please.
Hi, my name is Alice Xu. I'm working in University of Manchester. I have a question for Professor Fernando. So thank you very much for your presentation. And I believe there's indeed a lot of contradicting evidence in literature about how the creditors value conservatism. For example, I can recall a 2013 JE paper by Tan, who documents that when debt covenants are breached, the borrower's conservatism increases, implying that when the control rights are in the hands of creditors, they do require conservatism. But for me, it's very confusing that, as you mentioned previously, the DRAM paper documents that when creditors, they design the contracts, they don't incorporate covenants. They don't incorporate more conservative adjustments to the covenants. So can you suggest any factors that contribute to these contradicting findings, especially those factors that we can use as conditional variables in our papers when we model the relation between conservatism and debt contracting? Thank you.
Okay, well, thank you very much for the interest and for your words at the beginning. The second to last slide in Alfred's presentation, he had these sentences like, I don't know, this, some assertions are not very, are discomforting, okay? And I don't think that the findings that we have reproduced here, or talk about here, should discourage us. Okay, I think that conservatism is important and will be present in accounting, and this is because human beings, we are conditionally conservative. And neuroscience and psychology literature shows that we are conditionally conservative. We care more about losses than about gains. We remember losses for ages, and we forget about good experiences fairly fast. So the result in Direct et al., it's simply, it doesn't mean that conservatism is not important. It simply means that performance governance don't seem to rely on conservatism. We need to look at other covenants, capital covenants, or perhaps other type of covenants, and to verify this assertion that we make, which is based in common sense, or if you which is based on verbal theory, that conservatism is useful in debt contracting because it accelerates the triggering of debt covenants. Probably this is the case, but we need to find out which are the covenants that are based on accounting conservatism. I like the paper that you mentioned, the TAN 2013, I think, because he uses a regression discontinuity design. So from a technical point of view, I think it's very promising. I had included that paper in my presentation, but because I thought, well, I'm going to run out of time, so I did not include it eventually. But anyhow, so as Alfred was mentioning at the beginning, in phase one of any of the research, we tend to do a very simple assumption. Right? Conservatism is good, okay, and more conservatism is better. Okay, perhaps this is the case, but we need to refine this assertion. Okay, perhaps not always more conservatism is better. Okay, there's a certain limit to the efficient amount of conservatism. So these are possible avenues, okay, to explore, and that will bring the field forward.
Okay. Anyone else? Please.
Hello, I am Mustafa Haraki from the University of Manchester, Accounting and Finance. And I have a question to the panel, mainly to Professor Penalva and Professor Wagenhofer, because it concerns conservatism. As you mentioned in your slides, there is a big positive association between leverage and conditional conservatism. However, recent papers show that the metric used for conditional conservatism, the Bazou or the C-score, which is a development of the Bazou 1997, is biased. And this positive association between leverage and conditional conservatism is mainly attributed to the asymmetric distribution of returns. So away from empirical evidences, which are contradicting more or less, do you think that debt holders or debt markets in general prefer conservative reporting or simply neutral reporting? Thank you.
I can be brief with what theory would tell you. In any contracting setting, I guess being neutral is probably a zero event. So it's always better to be biased on one or the other side, because being neutral would require that any decisions you take is just the knife-edge case of doing things. So essentially, it's hard to say in what direction it goes, but it's easy to say it's probably never neutral. So,
Yeah, regarding what you mentioned about the, I didn't touch upon this in the presentation because of lack of time, but the measure of conservatism, the proxies that we use, we know they are not perfect. Okay, they contain noise, they are biased, etc., etc. And now there is more and more research that points out to the deficiencies. Okay, I think that the latest pieces by Duta and Patatokas is forthcoming in the accounting review. Okay, and so what they find there is that it kind of almost kills Basu. Okay, the good thing is that they move the field forward and they propose a new measure, okay, of conditional conservatism, and they show that the measure is not biased, etc., etc. But there are more people working on this thing, and I think that the news about Basu's death are greatly exaggerated, okay, because so far the results that Basu's measure has produced, I don't know, are in accordance to theory and empirical evidence that we observed, etc. So, nevertheless, we need to refine the measurement, and that's the nice thing about being an academic, that okay, that you are faced with unknowns, with challenges, and then you try to move the field forward by supplying solutions or answers. Eventually, somebody will get it right, and then we'll move on.
I have a question for Professor Alfred Wenhofer. You mentioned about, briefly in your presentation, you mentioned about somebody who trade the debts. For example, you have bond traders, you actually buy, hold, or sell, and you have bond analysts who make buy, hold, or sell recommendation. From the theoretical perspective, do you think that accounting information really matter for people who really make recommendation on those instruments, or for people who really trade those instruments?
Well, I mean, what I can say is that the ISB and FASB address those people because debt markets are really big. And there must be some benefit out of that. And I think, I mean, they obviously collect much more private information, but one can say that in many cases, if you have public information, that will be the cheaper way of getting more information into the debt market. I'm not aware of a sort of specific way of how these people use that information, but obviously, particularly with public debt, there is, this is the base information to use.
Okay, great. Okay, great. Last couple of minutes, I'm just going to use this opportunity to introduce to you the special issue from ABR. If we can fire up the slides, please. Brilliant. So, yes, as the title of the special issue indicates, it's basically all areas, in relation to the role of accounting information in the debt market. So, could be, bank accounting, debt contracting, public-private debts, and also interaction of accounting information with, credit ratings. So, ABR, we're a broad-based accounting journal, so we encourage different methodologies and different theoretical perspectives, and so quantitative or qualitative studies are all welcome. Studies from different jurisdictions with unique institutional settings, would be interesting as well. Here's the list of some of the potential research questions. Obviously, you're not limited to this. It's just for, guidance purposes. Now, in terms of the deadline for the special issue, as indicated here, is going to be the 1st of July, and that would be 1.5 months from now, so you still have time. The papers will go through a standard review process, which is 2 reviewers. We have 2 reviewers. And then basically here, we mentioned here late 2018, that's just for guidance. purpose, and then papers that get through the review process, obviously accepted earlier, will be disseminated online as soon as possible to maximize the impact. Now, just for some of you who are not familiar with ABR, in case you're PhD student or new to the community, ABR is a SSCI ABS3 journal, and most current impact factor stats that we have is 1.347, and that ranks us as 32 out of 94 in the Thomson Reuters business finance category of journals. So you can see here we have a list of some of the most downloaded and cited papers in our journal. So anyway, we look forward to your submission to the special issue if you have any papers in the relevant area. And on a more broader basis, consider ABR as your research dissemination channel for any sorts of studies in the accounting kind of discipline. So at the end, I would like to wish you a pleasant stay for the rest of the conference. And can we just thank all three panelists again? Thank you.